Welcome to The Explainer. Today, we're digging into a question that's making a lot of people, well, pretty nervous. Are we seeing unsettling parallels between the 2008 financial crisis and the risks we're facing in 2026? Is history about to repeat itself? Or maybe even worse? Okay, let's just dive right into this quote. I mean, it really sets the stage, doesn't it? This isn't just about numbers on a spreadsheet. It's about a feeling, this sense of déjà vu that has the markets completely on edge.
So here's how we're going to break it all down for you. First, we'll do a quick rewind to the 2008 crisis. Then, we're going to lay out the direct parallels with today. After that, we'll explore the key differences, the things that might actually protect us. Then, we'll look at the new threats on the horizon, and finally, what you should be watching for.
All right, so to really understand what's happening now, we have to remember the past. Let's do a quick recap of what made 2008 such a complete system-breaking catastrophe. You see, the crisis was this absolutely devastating chain reaction. It all kicked off with super risky subprime housing loans. But the real explosion? That happened when Lehman Brothers, a massive investment bank, was just allowed to fail. That one single event completely vaporized trust. The credit markets, the actual lifeblood of the economy, they just froze solid. You could see the panic in indicators like the TED spread, which basically measures how scared banks are to lend to each other. The whole global financial system was staring right into the abyss. Now, this is what's so critical to understand. This wasn't a hurricane. It wasn't some external shock. As economist John Quiggin points out, this was a crisis born and bred right inside the financial system itself. It was enabled by a hands-off approach to regulation and just really flawed incentives. So how does that connect to today's world? If 2008 was a self-inflicted wound, have we just put the same weapons back in our hands? Are all the ingredients for another disaster sitting right here, right now? Okay, so the bubbles themselves look different on the surface, but the behavior is just eerily familiar. Back in '08, the obsession was housing, taking risky loans and packaging them up to look like safe investments. Today, well, a lot of people are arguing the bubble is in AI and tech stocks, and it's being fueled by huge amounts of corporate debt and kind of blind faith in future growth. And check this out, another spooky parallel. Before 2008, a lot of the risky lending came from what they called shadow banks, places that operated outside the normal rules. Today, that role is arguably being played by this booming and just as murky private credit market. So what in the world is private credit? Well, think of it as a parallel lending universe. It's where companies go for money when they can't or maybe don't want to go to a traditional bank. The real danger here is that it's so opaque. Nobody knows for sure how tangled up these funds are with the regular banking system or who's going to be left holding the bag if these loans suddenly go bad. And that, my friends, is a classic recipe for systemic risk. And the growth? It has been nothing short of astronomical. We're talking a fourfold jump in just one decade, from $500 billion to over $2 trillion. That kind of growth rate just blows past the real economy. And it has echoes of that same rapid, unchecked expansion we saw in the years right before 2008. Okay, but hold on. It's not all doom and gloom. It would be a huge mistake to think nothing has changed. Proponents will argue that some key parts of our economy, especially the housing market, are built on a much, much stronger foundation today. And the proof is right here in the data. Those reckless ninja loans, you remember, no income, no job, no assets, that fueled the 2008 fire? They're basically gone. They've been replaced by what are called qualified mortgages, which means today's borrowers are fully documented, they're stress-tested, and they have some of the highest credit scores in history. Look at that. Subprime lending has tanked from 20% of the market to less than 1%. And all that creditworthiness leads to this number. $11.5 trillion. That is the record-shattering amount of tappable home equity that Americans are sitting on right now. It is a massive financial cushion that simply did not exist back in 2008. And this stat really drives the point home. With almost 40% of homeowners owning their properties free and clear, the market is just way more stable. People aren't going to just walk away if prices dip a little. Today's foundation isn't a house of cards. It's more like a fortress. So, if the old threat from the housing market is contained, what's the new one? Well, the danger isn't a simple repeat performance. The real risk is an evolution, a cascade of new interconnected shocks all hitting us at the same time. The Economic Survey for 2026 is warning about this exact scenario, what they call a systemic shock cascade. It's a situation where you have financial stress, technological disruption, and geopolitical chaos all happening at once, feeding off each other and creating a crisis that's way more complex than what we saw in 2008. So here are the four horsemen of this potential new crisis. First, the tech and AI bubble bursts. At the exact same time, geopolitical conflicts heat up around the world. Third, the panic spreads globally in seconds, not months, thanks to our hyper-connected markets. And finally, all of this happens in a world where the major countries are less and less willing to work together to stop the bleeding. And that lack of coordination, it leads to maybe the scariest question of all. If this new crisis hits, do governments and central banks even have the tools left in their toolbox to fight the fire? Think about it. In 2008, the world's central banks acted almost in perfect harmony. They slashed interest rates, they unleashed gigantic bailouts, but today, their options are way more limited. Government debt is at record highs, inflation is proving to be sticky, and frankly, the level of geopolitical distrust makes that kind of global coordination feel like a complete fantasy. So the bottom line is this. That safety net we all relied on back in '08 is now dangerously frayed. The old playbook of just cutting rates and printing money, it might not be available next time, or at least not without some really severe consequences. So, all of this leads to the most important question, right? Given this complex, fragile situation, what are the key signals that you should actually be watching? You're going to want to keep your eyes on these four things. First, unemployment. If that number suddenly jumps above 6%, that's a sign of real trouble. Second, inflation that just stays stubbornly high no matter what central banks do. Third, watch government bond yields. If they start spiking, that is a major sign of market stress. And finally, of course, keep an eye on those geopolitical flashpoints that can disrupt global trade in an instant.
And what do you get when you have a stagnant economy and high inflation at the same time? You get this word, stagflation. It is a toxic economic cocktail, and it creates an impossible trap for policymakers. And it's a word that economists, even those at Bank of America, are now using to describe the environment we're heading into.
So at the end of the day, here's the thought we want to leave you with. The crisis of 2026, if it does come, it won't be a carbon copy of 2008. It's going to be an evolution, faster, more complex, more interconnected. The fundamental question isn't whether another bubble is going to pop. The real question is, when confidence inevitably collapses, can this new, faster, more fragile system actually hold?